This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Brett Steenbarger. He is a repeat guest. This is his second visit. Brett is a clinical associate professor of psychiatry at the State University of New York. He's the author of The Daily Trading Coach, The Psychology of Trading and Enhancing Trader Performance. His newest work is Trading Psychology 2.0, From Best Practices to Best Processes. I always enjoy a conversation with Brett because I truly feel like the kid in the classroom, that everything Brett is going to say or talk about or write about, I have to pause, sit back, think, contemplate. Brett's not just giving the sound bites. There is a tremendous amount of depth behind his thinking and his insights. I hope you enjoy this conversation with Brett Steenbarger. I've seen you make the comment, you're paraphrasing, you're quoting from Bobby Knight, and I'm guessing you must be a fan to some degree. Why do so many of us have the burning desire to succeed, but not the drive to prepare for the success? Before you answer that, I want to add one thing to that. Do people really have that burning desire to succeed?
It's a great question. I do believe the majority of traders go into trading with ideas of success. Now, those ideas may be fantasies, they may be plans, but they're drawn to trading in large part, for the outcomes. The problem that often occurs, and I see this more among beginning traders than experienced ones, is that part of what draws them to trading is the allure of not working a standard 9-to-5 job, and that it seems to them that this could provide relatively easy riches. And of course, as you and I know, it's much more than a 9-to-5 job when you do it right. The fantasy of the easy riches collides with the reality of what you need to do to prepare to win. And I think that creates quite a dissonance for many beginning traders and ultimately leads them to leave the field.
So is it a burning desire more for it's a burning desire for the outcome, but not too many people will take the step back and say, okay, hold on. And maybe you get into it, you say, I just see the outcome. And then you get into it and you take a step back and you start to break these pieces apart and you say, hold on, we can't just focus on the outcome or we will go crazy. We must break this down. We must look more at our process. Why don't you talk about that? Because I've seen you in some of your recent work, and I would love for you to draw some distinctions here from process to practice to process. Break that apart in how you're describing to clients and people that read and follow your work.
If I can address the earlier point, which I think is a good one, the distinction I like to make is between those who have a self-proclaimed passion for trading and those who have an enduring passion for markets. Those two are very different, and the person with the passion for trading wants to trade and ultimately ends up over trading. But when markets are closed, there's nothing to generate passion. That's very different than the person who has a passion for markets, where it's more of that process interest of understanding, unraveling, reverse engineering what's going on in markets and figuring out ways to better exploit that. So I think those are very different motivations and end up with very different consequences for traders. Your second question about practice and process to me is essential, and that's really what one of the big factors that got me to write this latest book of mine, The Trading Psychology 2.0. So often you hear traders talk, and again I see it more with the beginning traders, you see traders talk about finding your edge, sticking to your edge. All well and good. However, that, of course, doesn't take into account the reality that markets are ever changing and that finding your edge is a continual process, that as markets change, edges, sources of edge, evolve. And so we always have to be evolving ourselves. The way that happens in the medical world, where I came from, is through identification of best practices. What are the practices that lead to the best outcomes? And then turning those best practices into robust processes so that the best practices become habit patterns. They become automatic. I think that analogy in evidence-based medicine is quite apt for trading. We want to find the drivers of our success, what makes us successful, and turn those into processes that become replicable.
I'm going to break apart some of the big picture issues in your current life, your current world, your current work. But as you mentioned, markets always changing. And one of the lessons that you talk about and being around so many traders, studying, teaching, training, is adaptability. And literally from the beginning, if one strategy is not predicated on being adaptable to the markets, and the markets are the driver. We can't control the markets. And so whatever the markets must do, and they will do something, adaptability is number one, isn't it?
Yeah, absolutely. A great recent example that I've written about is in your area of expertise, Mike, and that's trend following. Trend following, as it occurred in the late 1990s, is quite different from trend following right now. There are portfolio managers and traders I work with who are trading trends, who are trying to identify trends to trade, but the way they are executing on their trend trading is more similar to what happened in the late 1990s, where they are mixing, confusing, I would say, trend with momentum. So that if they're long, they're buying strength. If they're short, they're selling weakness. What we've seen recently are markets that show anti-momentum in the short run, even as they are trending. A different way of saying that is that the trends have a lower Sharpe ratio. How you implement a trend-following approach requires adaptability. You may stick to your basic orientation to markets, i.e., trend following, but how you make that happen, how you put it into practice, has to be based on outcomes and your study of markets. That's where the adaptability comes in.
You know, it's an interesting point that you bring up, and it gets even more complicated as the numbers of large funds that we all read about, that we see the headlines, we see the quotes from, trying to decipher. You know, when you read about a large fund that's managing billions and billions of dollars, and let's say that they started off as a trend following fund, and perhaps they still have billions and billions of dollars still as a pure trend following trader. But there are many funds today where they're adding other things and they're adding other strategies. That raises up a whole different issue, which is really one, in my humble opinion, not really of markets, and it's more a result of clients. Because when I talk to the pro trend following traders, if you talk to them on the record for public consumption, they're going to talk about a certain way, and it really is an appeal to clients. You get them off the record, when the microphones turn off, they're just like, oh my gosh, it's such a pain in the neck to deal with clients that don't understand our strategy.
Yeah, that makes a lot of sense. And I think for a fund, diversification makes sense, and having multiple approaches. And so there may be trend following approaches, and there may be relative value approaches, and so forth and so on. You know, I think having diversified sources of return is a good thing for investors. One of the things that I've seen in the fund world is that investors have very limited appetite for the downside. And I would say that's been true ever since the '08 debacle, that they want to see funds make money. They don't want to see funds lose money. And so funds are managing risk much more tightly than in the past. So that even though in name they may be trend followers, in fact, any wiggles against the trend, that lower Sharpe ratio that I mentioned, ends up getting them out often at the worst possible times. So that sometimes it's the business pressures and the pressures of risk management that make it difficult for a trader to implement their strategy.
I would also advise clients or people that are interested in a subject like trend following. We're going to talk about a lot of different aspects of trading psychology today, but sometimes the performance proof, you can go to those track records. Those track records often have remarkably insightful data about them. And you can look at those track records, and I can think of some names, and you look at those track records and you say, wow, they've stuck to their religion, so to speak, for decades. Then you can look at some others and you say, you know what? A very consistent return number every month is just not trend following, even though it might be advertised that way. So I think it's really incumbent on individuals to do their homework and really try and find out, because sometimes the public pronouncements don't match the performance data.
It's a great point. And one of the downsides of having so much computing power and software power right now is that it's relatively easy to backtest strategies. With enough iterations, you can find randomly a strategy that will look good not only on the backtest, but on out-of-sample performance. So it looks like a very smooth, wonderful, ideal P&L curve, but of course that doesn't match the reality of real-time returns.
You did bring up a good point, though, about the backtesting. I mean, backtesting and trying to, if you're in the systems world of some type of system, a backtest, that's where it all starts. And I'd like for you to lead this into a broader subject area, which is preparation, because so much of elite performance really starts at that research level, that preparation level, that backtest level. And the ultimate execution often can be very quick or can occur in a fast manner, but it's all that prep time, that real deliberate practice is where the gold is made, so to speak.
I think so. And as I mentioned in the Trading Psychology 2.0 book, the key in performance fields is that elite performers, spend more time in preparation than in actual competitive performance. That there's a lot of practice time that goes into the curtains being raised on the Broadway play. There's a lot of practice time that goes into the first game of a chess tournament. And that preparation works at two different levels. It helps develop a strategy, an approach, and it helps prepare the performer mentally, psychologically, emotionally. That preparation time, I found, is correlated with success to the degree that it pushes the trader to expand their horizons and develop the best of what they're doing.
Let's just talk about pro traders for a moment. You've seen pro traders at the highest levels. Why don't you draw some contrasts? For example, I think the audience might have a hard time imagining that there are some pro traders at the highest levels, perhaps, maybe with long track records, perhaps a lot of money under management, and the way they go about practice might not be nearly as good as one of their peers who might have deliberate practice down to a science. Everything is really thought out. There's some contrast, even at the highest levels, isn't there?
Very much so. I'm really blessed by being able to work with a number of very talented traders and very successful firms. In fact, the smallest firm that I work with has about $3 billion under management. So, traders in those kind of firms have to do something right and have to have some real strengths to get to that point of managing significant capital. But you're right, even within those funds, between PMs, there are real differences in the preparation approach. And I would say there are two sources of difference. One is the one that you mentioned, the difference between repeated experience and deliberate practice. Some managers of money, some traders really rigorously keep score, and they try to learn from their trading. And what did I do wrong? What could I improve? How am I going to improve it tomorrow, next week? So they're constantly keeping score, setting goals, and then keeping score about whether they reach those goals or not. That's the essence of deliberate practice. The second thing that distinguishes the successful traders is the emphasis on what they do right, their strengths. What positive psychology research is telling us is that it's leveraging our strengths, not just shoring up weaknesses, that accounts for elite performance. And so we want to figure out, what are we doing well? Because those are the practices that will anchor our best processes. And so in two different respects in preparation, identifying what we're doing wrong, correcting that rigorously, identifying what we're doing right, and turning those into best practices, that is real preparation.
I only brought it up because it was in your work most recently, but deliberate practice, I'm my fingers crossed. Anders Ericsson has said he will come on in 2016 to talk about his seminal work, so I look forward to that. Let me drive back at the strengths aspect for a moment. So let's say we're kind of giving advice to the new trader at the table. To some degree, and let's say we're kind of talking more of a system mindset, and I think these days, most everything is a system to some degree. I mean, even if it's a discretionary type thinking, there's a system behind it. But talk about strengths, because it seems like to me, one doesn't really have the ability to think too much about the strength they have. Let's say you're going to be a systems trader. As a systems trader, you have to have your entry-exit criteria. You have to know how you're going to manage your portfolio. What's the risk management strategy? You can't just leave one out. So I would love for you to kind of elaborate more on the strengths part, because it seems like you're saying, and I could be reading this wrong, that we all have there's some built-in strength about one aspect, and to kind of really focus on, correct me, what am I missing here?
Well, no, I don't think you're missing anything. I do believe that the strengths that make a good systems trader are different from the strengths that make a good discretionary trader. So much of the success of systems pertains to the research and the quality of the research that's conducted. And so, in some ways, the strengths that are relevant to a system trader are not so different from the strengths that are relevant to a medical researcher. The information you take in, how you process that information, how many variables you look at one time, and how you weight those are all part of what can be best practices. There are also strengths interpersonally. Many times the research is too complex to be conducted individually. I work with some people who develop relatively high-frequency systems. And those systems are developed in teams. There are programmers, there are quants, there are traders. And so being able to work well with others, those are strengths that are very relevant to best practices and to ultimate outcomes in the systems world. For discretionary traders, strengths are different and often pertain to the amount and type of information that's taken in, how that information is translated into tradable ideas, how those ideas are expressed as positions and managed as positions, including the risk management. And of course, there are best practices related to not only risk management and position management, but self-management, how we take care of ourselves. All of those go into making someone successful. There's no one process of trading. Trading consists of multiple intersecting processes.
I brought something up a few minutes ago. I talked about some of the big things that you've learned from all the traders that you've looked at. I mentioned adaptability, creativity, productivity, and self-management. Why don't you talk about creativity for a moment? I have a feeling for many traders, just even entrepreneurs, venture capitalists, creativity for those that are in the business, they probably think of it as instinctive. It's something I do all the time. But defining creativity like you've done changes the ballgame a little. It forces us to think about the word creativity. And I don't necessarily know that a lot of people would immediately think, oh, I have to be creative to be a trader.
Yes, to the degree that we regard trading as a business, then I think it makes sense to say we have to be doing something unique in order to be superlatively successful at this business. If I open a hamburger stand that's just like every other hamburger purveyor, then how am I going to achieve a significant degree of economic success? I have to do something different, unique. And it's in that difference, that uniqueness, that creativity comes into play. We see that in financial markets because many times the herd is following a similar set of strategies, looking at the same information and processing it the same way. And that's why you see swings in sentiment that often end up being relatively good contrary measures. That's why you see many people getting hurt at the relative tops and bottoms of markets, because they are doing things that really are not unique, not creative. And it's particularly an issue in the professional money management world, where there tends to be a high correlation among financial markets. The Financial Times had a piece on that recently. There also, as a result, tends to be a high correlation of returns among portfolio managers within a firm and across firms. And so that is a problem for investors. Investors want to diversify their capital. A trader who has the creativity to examine, test, and implement new strategies is going to be very appealing to anyone who invests and wants that diversification.
You know, you just mentioned, you said, well, clients want the diversification. And we talked earlier about, you know, sometimes clients actually, they might say they want diversification, but then they're doing anything they can to avoid volatility, to avoid taking excess risk. And I was thinking, as you were just talking about, okay, so many investors, traders, they're looking at the same info. They're processing that information in the same way. There's nothing unique about it. And they're simply fixated on comfort. And as you point out in your work, it's the adaptation. It's got to hurt a little, the hurting a little, or maybe even hurting a lot. That's where the reward often is, in some kind of perverse sort of way. That desire for comfort can set one up for, as Nassim Taleb talks about so much, the black swan. So comfort's often illusion, isn't it?
I agree with you, and it's hard to imagine us extending our boundaries, really transcending who we are, if we aren't willing to go outside our comfort zone. That can be done in a variety of ways. It can be done by looking at new markets. It can be looking at existing markets in new ways. It could be looking at new and different time frames for implementing our trading. There are many ways of doing things new and different. One example from my own recent trading, it has been a redefinition of volatility. I find that volatility is very important to market returns, and in the models that I create, volatility ends up being an important variable. As we know, with stocks in particular, volume and volatility are highly correlated, so that markets move more when there's more participation, which makes sense. But I got it in my head, well, what if I looked at volatility a different way? What if I looked at the volatility of a given amount of volume in the market? If X number of shares trade or X number of contracts trade in the market, how much movement is associated with that amount of volume? You're disaggregating the relationship between volume and volatility, which I call pure volatility. And it turns out that that has real value as a variable for understanding markets. Because when you see volume expanding, and when you see the movement per unit of volume expanding, you can get some very big moves. That's an example of creativity, looking at something similar in a unique way.
We've been talking about markets, how markets are the drivers. But at the end of the day, yes, markets are the drivers. We as individuals have certain built-in, and I want to kind of let you break this apart. We've got a certain personality. We've come to the game with something. We behave in a certain way. We think in a certain way. We react in a certain way. Our emotions go a certain direction. But I find the word personality is often difficult. And I know you point out, and correctly so, and Jack Schwager has said it for a long time. He said, you got to trade your personality. But I think for a lot of people listening, that might be really hard to digest. You say, well, hold on. I don't necessarily even know how to define my personality in any kind of a rigid or quantifiable way. One could go out. There's several personality tests out there, or personality instruments, shall I say, since I am actually qualified to administer the Myers-Briggs instrument. It's not a test. So, but that can be confusing, and there could be debates about that. So why don't you break apart the word personality from your perspective and give some guidance to the audience out there that's thinking, man, I might not even be sure what my personality is. And if I do know, how do I make the decision to go which direction? It becomes a quite complicated conundrum to figure out, doesn't it?
Yes, I agree with you, and I think it's even more complex than your question implies, because as you mentioned earlier, it's not just personality traits, it's also our cognitive style, how we think about things. We have personality traits, emotional traits, we have cognitive traits, and so we want to leverage our strengths in both of those domains. Again, I think that reverse engineering the success of our trading can provide some real clues as to some of those strengths, some of those signature personality and cognitive strengths that would contribute to our success. What I found from the research I've done with traders is that average holding period ends up being a very important variable, particularly on the cognitive side. I would make a distinction psychologically between a trader and an investor. The longer time frame necessitates a higher degree of underlying research, and the longer term research becomes really the focus of the trading of the market participation, not the day-to-day movements of the underlying assets. That's a very different set of strengths from, let's say, the day trader, the active day trader, who is looking at markets moving rapidly, is seeing patterns set up very quickly in markets and trading those patterns. So there's very little explicit research, reading, calculation. It's all about fast pattern recognition. The distinction that has been made between thinking fast and thinking slow is very relevant there. The deeper thinking, the faster pattern recognition. And as Kahneman talks about, those are really two different brain functions and two different modes of processing information. Now, in addition to that, we could distinguish two types of trader or investor, personality-wise. One is highly risk-taking. They tend to be more outgoing, more extroverted. They tend to be more stimulation-seeking, more aggressive, and are willing to take more risks in the pursuit of higher returns. The second group of traders is less interested in absolute returns than in risk-adjusted returns. They're less risk-taking. They're seeking smoother P&L curves, higher Sharpe ratios, and very often are seeking what we would call alpha rather than beta. They tend to be more analytical in their cognitive style. They tend to be more introverted in their personality style, and so a very different approach to markets. Those two dimensions, the holding period, the research orientation versus pattern recognition orientation, and the element of risk-seeking, versus risk-adjusted return seeking are just a few ways people could think about personality and cognitive style and how that might relate to some of their strengths.
Brett, I know your job is not necessarily to offer a personal opinion about what I'm going to ask you, but I'm curious because you just mentioned the phrase smoother curves. And if I think back over the last 15 years, we've had two, if an investor, if they classify themselves as an investor, just a kind of a buy and hold approach, an index type approach, we've had two 50% drawdowns in the S&P. I think it's reasonable to assume that if that's one strategy to trust the S&P, it's reasonable to assume that could happen again. And now, of course, when it comes to trading strategies like trend following, a smoother curve, if somebody says they want to be a trend following trader and they want a smooth curve, I would say, well, then you've got the wrong strategy. There's no such thing. But is there really a smooth curve for anybody? Except, as you mentioned earlier, and you didn't say this, but the pro high frequency traders that can generate, I think I read a couple years ago, one of the big iBanks, is literally they made money every day of one quarter. So, but I don't even know if that's trading. That's technology, that's infrastructure, that's access. That's not a competitive thing where I can compete against JP Morgan on the high frequency level. I can't. But talk about that for a second. The idea of a smoother curve, is that just a false ideal, a false goal?
Not at all. Not at all. I think for any one strategy, the P&L curves are likely to be bumpy. And as you point out with the S&P, for instance, if one were simply an index trader. However, the idea of smoothness of P&L curves is really all about diversification, portfolio construction, and combining different approaches to markets to balance the returns. The basic risk parity notion of buying a volatility weighted basket of interest rate instruments and equity instruments would be a case in point that in recent years that basket has had a smoother P&L curve than either asset individually. You could expand that more broadly to a basic asset management approach. For instance, if you think about returns as being generated by certain factors, trend or momentum could be one factor, value could be one factor, carry could be another factor, then you can combine investments or trades that express those different factors and that harvest returns from those factors in a smoother way than if you were trading one strategy in isolation. And so asset management in general as a field, I think, is all about achieving smoother returns, more unique returns, rather than chasing beta from any given market.
Yeah, I was definitely just speaking to one strategy. I think of course you're right. Once you add in multiple strategies, the notion of trying to find a smooth curve is that's the goal. That's what many people do, I guess. But in the notion, I think if some people think they can find a smooth curve, a smooth equity curve from just one strategy in isolation, that might be very difficult.
I agree with you. Probably the Bible of the asset management world would be Antti Ilmanen's book, Expected Returns, and very much worth reading about, because I do think that there are things that individual traders can do to improve the smoothness of their returns. Even as you say, they can't completely smooth them. There's always going to be those bumps in the road. A very simple example would be trade expression, that a given view in a given market may have more favorable risk reward if traded with an option structure than if traded with an asset outright. There are ways, I think, of achieving better risk reward, but that doesn't eliminate the potholes along the way.
For all of these, and we're not necessarily defining strategy here at the moment, but regardless of what one strategy is, talk about the emotional buy-in. If there's no real emotional buy-in, success is just never going to happen, is it?
Well, it's a very good point. And the emotional buy-in occurs because the trading approach or the investment approach is genuinely yours. You have researched it. You have thought about it. It springs from your creativity. It springs from your work. And it's the time and effort generated that generates the strategy that helps you understand it and believe in it. That's why it is perilous to borrow trading strategies from others, because at the end of the day, you're really not trading your strategy, and it's unlikely you will have the conviction to stay in that strategy during those inevitable periods of drawdown.
Well, of course, you're talking to a guy that wrote a little book on the turtles, and I think some of them would say it's nice to have a head start. And I think it's kind of it's a multifaceted point, really, which is if you take a strategy, if somebody gives you a strategy and you don't understand it, and you're just going to follow it like a black box and just trust the signal that comes out, that's death. You're not going to make it. However, we all have to learn from somebody. We have to start somewhere. So if you can get a head start, if you can move down the path, as long as you understand what's going on, of course, that's how we all learn. So it's kind of a several layers there to that topic, huh?
Yeah, I love that point, and it's really about mentorship, and I see a lot of good mentoring at the firms where I work. You're right, in the very beginning, when you have a junior trader who is working at the side of a senior trader, it starts with a head start. It starts with the junior trader mimicking the trading of the more senior trader. And just like in the old days, the beginning painters mimicking the brushstrokes of the masters. That's what mentoring is all about in the earliest phases. And it is a head start, as you point out. It's over time, as people make their own unique observations of markets and adapt their trading to their strengths, they start to develop their own style and begin to express that approach to trading in their own manner. To take the example we've been talking about, someone may learn at the feet of the master trend following, and over time may implement it in new and different markets, may implement it on different time frames, may implement it on relative price movement rather than absolute. There would be many ways to make the strategy one's own over time and develop that conviction that helps people stay in the strategy once it's theirs.
Let's talk about the notion of a checklist and ultimately moving that towards a flow chart. Something concrete. I mean, it's a standard operating procedure. I mean, it really, and if people are listening to you, I asked you the question about personality. Your personality as you talk is your work. I mean, anybody with a pulse would read your book and then listen to this podcast and they'd be like, okay, those are both Brett. Those are both Brett. I mean, there's you just know we're dealing with the same person. As my mother had read my books and she said, okay, that's you. I can tell that's you. But talk about the notion of a checklist, because in your personality, that I have a feeling just is simpatico. It's natural for you. It might not be so natural for other people. Or am I wrong? Was it natural for you, the checklist?
No, I wouldn't say it was natural, and I think that for me it was part of an evolution. I think that's true for many people. When Atul Gawande wrote the book, The Checklist Manifesto, he wrote it, I think, because he saw that checklists were not standard operating procedure for most people, and yet they worked remarkably well for airline pilots, for surgeons, and so forth. And so the idea of a checklist is to figure out those best practices. What are you supposed to be doing when you perform well? And you codify that in a list. And you don't perform, you don't risk your capital unless you do A, B, C, D, and E. Over time, you may discover new and different best practices, and so your checklist will evolve. But it's a way of grounding yourself so that once again, those best practices turn into habit patterns. They turn into processes.
Brett, how many traders do you get that come across you for the first time? Maybe they've engaged you, maybe it's just casual conversation, and they've got so much excitement. And maybe that excitement is an unbridled excitement. It's not necessarily focused. They're focused on the outcome. Your personality probably does a very good job of calming people down. And if they can't calm down and take it to a checklist type scenario, it's probably a pretty good self-reflection of saying, hey, you know what? Maybe this isn't for me.
Yes. And again, a good point. Many people are trading implicitly for action, for thrills, there's nothing worse for them than a quiet market. That approach to trading really rubs against the grain of being more process focused and keeping checklists. So that I like people to be passionate about what they do. I like them to be excited about their work and about what they discover and what they trade in markets. But ultimately, you want them doing what works best. A great example in baseball history, of course, that you know about is Ted Williams and how he diagrammed the strike zone and determined his batting average for every possible location of a pitch, so that he knew where a pitch would have to appear on the plate for him to have the best odds of getting a hit. That's what people do when they develop best practices and checklists. They figure out what they do best, and they turn that into a set of routines.
Brett, I have one more thing I wanted to bring up with you today. I forgot to bring it up earlier. It's not really intertwined in our conversation. It's more on the outside, but I think, frankly, once one understands it, it's on the inside. And that's the notion of fitness. And I'm talking about physical fitness. I think we can all think back to some article we read in our youth, or we saw a picture. Maybe there was a trader or a very successful person, and they just carried in their public pictures an appearance that was clearly not healthy. And sometimes I think maybe even as a young man, I would say, okay, well, I keep myself healthy, but you might be thinking, well, it's not important. And I think overall, though, that even if you can think to the example of somebody, oh, that guy, he made hundreds of millions of dollars and he's really overweight and doesn't care about fitness, that's the wrong connection. That's the wrong way to look at it. Why don't you talk about health and fitness and perhaps even add in a little bit of your views on yoga and the moment of now?
Great questions. The research in psychology tells us that a positive emotional experience is associated with superior processing of information. It's associated with superior productivity. It's associated with superior creativity. Maximizing our positive experience in general is a way of preparing ourselves for trading performance. Part of that is our physical preparation, our energy level. Eating is part of that. Sleeping well is part of that. Physical exercise is part of that. Using yoga or meditation to help increase our focus and to help us stay calmly focused is part of that. The training that we do on the physical side, on the personal side, ends up fueling positive emotional experience, and that ends up giving us greater focus, concentration, energy level in our trading. I would say the same thing, not only of exercise, but of the quality of our personal relationships. That maximizing our positive experience from those ultimately fuels our energy level, and that ultimately fuels our trading.
Brett, it's cool stuff. We could talk forever. I could just sit here and pick up ideas and pick up questions, and we could just keep going. The book is out. Where can we send people? Where's the best place we can send people to check you out and your assorted books? All highly recommended. If you've not bought them, then there's something wrong with you.
Well, the nice thing is plenty of stuff online for people to check out, and they can decide if
you've given so much stuff for free away over the years. I mean, checking out your blog and stuff, that's a wealth of information. So.
Well, thank you. Yeah, that's really where it starts, is with the Trader Feed blog. That's Trader Feed, all one word, TraderFeed.blogspot.com. I post to that daily. And then I'm writing a blog also most recently for Forbes. you could check out by Googling Forbes Brett Steenbarger. And then, of course, the most recent book that I alluded to earlier, Trading Psychology 2.0, is available at a discounted price on Amazon and really puts together, I think for the first time, puts together positive psychology research, recent psychology research, and what that specifically means for trading performance. That's what got me excited about that book. That might be worth checking out.
Even though it's about trading, I mean, we could really take out the phrase trading and your work could apply to just about any discipline.
I think that's very, very true. You know, trading happens to be the playing field that I've chosen and others have chosen. But in fact, the principles of performance are common across disciplines. Ultimately, we pursue the disciplines that speak to us.
Brett, hopefully you will come on again in the future and educate my audience, educate me. I think my blood pressure goes down just talking to you. I can't get as excited as I normally might be.
I wish it was that way for my kids.
Brett, thank you. Take care.
Okay, thanks so much, Mike. Great stuff.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.